Okay, so for those of you who actually have joined on time, I will respect your timekeeping skills. And I just really wanted to thank you all for joining this webinar today, where we're going to be looking at the pursuit of investment excellence. And I'm really excited. This is co-hosted by the Sovereign Wealth Fund Institute and Stamford Associates. I was actually introduced to Stamford about a year ago now, and I was really impressed by their rigor and attention to detail. And actually the Telegraph in the UK last year noted that they were perhaps the world's most thorough system of fund research for the way they incorporated behavioral psychologists into their investment process. So just a couple of words on today's format. We are very respectful of people's time, so it will be brief. It will just be a 15 to 20-minute chat between myself and Michael Hogg, who's the Deputy CIO of Stamford Associates, and then we'll also open it up to you for Q&A. I know that, 4 months into this working from home pandemic, I'm sure you're all very familiar with Zoom, but just in case you're not, there is a Q&A functionality at the bottom of your screen. So please do just enter any questions there. A few words about Mike. So Mike, as mentioned, he's the Deputy Chief Investment Officer of Stamford. He's a CFA charter holder. He's a chartered accountant. He's also got a PhD in physics from Cambridge University and a Master's in Science in Physics from Imperial College, London. So Mike, thank you so much for joining us today.
Hi there, thank you for joining me.
And so perhaps we could start, if you could just tell me a bit about Stamford as a company and the rationale for establishing the business.
Yeah, so we were established by Nathan Gelber almost 35 years ago now as an independent investment consultancy firm. We started small, but we now advise on more than 70 billion in AUM. And that's largely in active long-only equities, but it's also hedge funds, fixed income, multi-asset. So we have a slide here, I believe. Is that being shared at the moment, Rachel?
It is.
Great. So I won't dwell on this slide, but it does give a description of some of our key stats. So we have global coverage. We have over 40 recommended managers. Some of these come from a much wider knowledge of the active manager universe. Our team is 40 strong, and we think it's unique in construct, and I can go into more detail on that later. So we really created one key aim in mind, and that was to develop a more intelligent approach, a more reliable approach to finding great active investors. And so by great, we mean talented, and we also mean trustworthy. So they need to care about a client's capital, as an owner would, but they also need to be capable of adding tangible value over time. And if you look hard enough, these managers can be found. But unfortunately, you do need to look hard, because unfortunately, evidence does suggest that many active managers are simply not very good at all. So it's shocking, and these are third-party stats, but Spiver stats indicate that net of fees and survivorship bias, 90% of US domestic equity funds have underperformed over the last decade. That's 90%. So, it's dangerous. So there's a very high chance that if you don't do your work, you're going to pick a manager who's not only mediocre, but they're going to charge you for the privilege. So you need to be extremely selective. You need to be diligent, and you really do need to be eagle-eyed for any change. And I can come to how we do that later on in the chat, if that's okay.
Sure. I mean, that to me, that's an incredible statistic, that 90% of US domestic fund managers don't beat their benchmark over time. I did see from the attendee list that we have another of asset allocators joining this webinar today. What can asset allocators or fund selectors do differently? How do they find that 10% that do indeed beat their benchmark?
Yeah, so the stats vary by region, by the way, but they're not hugely better. So we tried to build our approach to answer what we think should be the two key questions, and they're on this slide, and they're really quite simple, but they're extremely important to answer well and to focus on. We need to ask ourselves, does that manager have an edge? And we need to ask ourselves, can we evidence it to us and to the client? So we have to focus all our energy on this, because we think if you miss this, you're missing the wood for the trees. This has to be at the core of any assessment of value for money. And by edge, what we mean is an ability to add value, but by acumen, by behavior or process, and it needs to be persistent. So not just a run of luck over the last year. So that's our main and key critical aim. So to try and do that, we've tried to build our process to to try and combat two key behavioural pitfalls in selection, and we've got them here. And they're not revolutionary, but the assumption, the first is the assumption that a star manager, perhaps with years of experience, must have talent, and that's just not a safe assumption. If you don't do any more digging, and that's all you use, you may well be backing the size of their marketing department, and that's not the same as talent. Second, everyone says it, but selecting a manager based on the past performance alone, extrapolating past returns into the future, you're expecting the same again, and that's an easy trap to fall into. Really, you might not even know you're doing it. You're rationalizing that managers with great recent returns, that they must be doing something right, and those with bad returns must be doing something wrong, and you look for the evidence accordingly. But that's incredibly, we think it's really, really dangerous, and it ignores a few things. First up, it's going to ignore the fact that it's going to ignore the fact that there has been different levels of risk taken in delivering those returns. So were they gambling? Were they skillful? That has to go to an initial assessment. Secondly, it ignores the fact that even the best active managers will deliver volatile return streams over short horizons. So returns in that sense shouldn't be expected to be consistent from great managers, because that can be part of their edge. So if these are the two things that are seeping into your buy case, you're going to risk buying a bad manager, or you're going to risk capitulating on a good manager at maximum pessimism. So if you do pick a great manager, you might not have the resolve to hold it through. So that could be classic value destruction at an allocation level. So we wanted to do something to build our conviction on something more than returns. So we wanted to focus our work on the real source of active alpha, and that's the key decision maker and the quality of decisions that they're making at the individual investment holding level. So we think that's repeatable, the quality of decisions, not historical returns. And that's what we've tried to build our process around to do differently.
I want to come back to some of those points that you just made about volatile return streams and also risks taken, but perhaps could you go into a bit more depth about the specific traits and behavioral qualities in managers that you look for?
Yeah, so we have a number of core principles, and we think they allow us to focus on what we know can work well if done well. So we believe this increases the chance of success for the client. It minimizes selection errors. It really revolves around these six things here, and we have them on this slide. So first off, because we're trying to identify skillful individuals, at the top of this slide, we're focusing on people. So people drive good active decisions, not institutions or dry DDQs or objective statements. Let's understand that person, that individual, because their decision making is unique and it's not necessarily portable. Next, we need to demand evidence, and that's off to the right here. We need transparency for that, and if we don't have transparency, we simply can't proceed. We have to independently corroborate claims. We can't rely on managers self-certifying that they're any good. Simply write down what they describe to us in a meeting, and that's as much a governance issue as anything. We're going to huge depth not to be sold a story, and our independence is really allowing us to do that. So for example, we'll use our own analytics. We'll use that on every decision a manager's ever made in a strategy, not just a snapshot. We'll bear in-depth case studies on individual stock selections and credit selections to test their rationale. We'll independently contact team leavers to try and cross-reference. Some things can't be known, we accept that, but there is no excuse for really not trying to gather the evidence. And that's the principle we look to, which sort of comes down to the next point, which is, what is evidence for us? For us, evidence can be behavioral as well as financial. So behavioral traits, we think, can be critical to adding value in active investment. So we're using relevant specialists. So we're using 3 qualified chartered psychologists as part of our appraisals, and they're integrated into our meetings, and they help us highlight evidence that others might miss. We're trying to cast a net as wide as possible. So we're also using former buy-side investment analysts on our team in a sort of poacher turned gamekeeper approach. We want to minimize the risk of recommending something based on an incomplete picture. In terms of type of strategy, we're really looking for managers running fundamental and high conviction strategies. So these are the managers you'll be familiar with are trying to tilt the odds in their favor. They're trying to understand their investments well from the bottom up. They're looking at business prospects. They're looking at valuation. They're trying to understand upside and downside. And they back that view with concentration. What they're not trying to do is forecast a changing macro with a crystal ball. These are people who want to be part owners of a business generally over time. And when we say time, we mean the long term, ideally. So we're looking for investors, certainly not looking for traders. So they're not investing with a view to the week or the quarter. It can be multiple years. It can be up to a decade. So that generally means we look for low turnover. But more fundamentally than that, it probably means managers building their investment case on a long-term perspective. So, I mean, frenetic activity can really add frictional cost. But more importantly, if you're trading around significantly, it's going to stretch your ability to add value and add insight into what you do hold. So 150 stock portfolio, for instance, trading 100%, that's 300 stocks you need to have a developed insight on. And that's a really challenging starting point. Finally, on the top left there, and this is probably most importantly, we're looking for managers with an absolute mindset. They consider risk not as volatility, but as the threat to permanent impairment of capital. And by threat to permanent capital impairment, I mean at an investment level. And that's really in keeping with an owner mentality. So volatility does matter, but for good managers, volatility is an opportunity. It's not a threat. That can be the source of an edge. It can be them profiting from a disconnect between price and intrinsic value. Now, for a bad manager, they can turn volatility into risk if they capitulate on downdrafts, and maybe they never really knew why they held that stock or didn't have enough conviction. But capital impairments are something we pay a lot of attention to, because if you sell a stock after it declines by 50% in return terms, the next stock you buy has to go up by 100% just to get back to the beginning, just to break even. You do that often enough, it's going to be a really significant drag on returns. It's a lot of effort, it's a lot of mental time and effort, and it's really not added value. So these are the 6 things we're really trying to bring together to sort of focus the lens of our work, really. And that's what we're doing here at Stamford.
Yeah, I think, you speak a lot about the quality of decision making, and I think some of the points you make about high conviction are particularly important at the moment, given we've seen this rise in passive strategies over the last decade. But as you point out, it's in times of volatility where really good active managers actually can come to the fore. So can you maybe go a bit deeper into the active management and conviction side of that, and maybe looking at conviction over the long term and how that plays out in different types of markets?
Yeah. So you're entirely right. So conviction to us means an ability to hold a position at a meaningful weight, but also it means the courage to hold that through volatility if that investment case is unimpaired, and that's a big if it's unimpaired. So that can be a really strong source of alpha over the long term. It might not pay off Q on Q, but over the investment horizon of that manager. We have an example here on the screen. This is just one example of one manager. The left-hand chart here is plotting 2 things. It's plotting the manager's turnover, their activity levels, and that's a light blue line there. It's also plotting the index return, and that's a dark blue line. And this is a 15-year period. So that's giving us a really long record of how they responded in a changing environment. And the first thing you see is that there are quite some significant market gyrations. So the market's up 60, so 100%, down 60%. Larger swings are happening at the stock level, of course. So the first thing to interpret is that there are no wild spikes in turnover and activity here. So that turnover level is maintained at roughly 10 to 20% throughout this volatile period. There's no peaking, troughing. There's no wild churning of the portfolio when the market goes down. So these managers have really held their nerve and they've carried on. So that's great as a first innings, but nerve alone isn't enough. So they need to have great stock selection, and we need to check whether that's adding value. And in this instance, we've got a drawdown analysis, which is on the right here, and it shows it certainly was. So it's showing that the stocks in the portfolio, if they declined by 40% or more at any point in their hold, they really sank, what is their success rate? So this is showing that for 40% or more declines in individual stocks, they were right 80% of the time to hold on. So 80% of the time, they went on to recover all that downdraft and then more. So they moved into positive returns. Not only that, it's showing that the size of the winners were 9 times the size of the losers. If you start to add on declines, trim on gains, you really start to compound excess returns if you have this approach. But if you have a lack of conviction, if you're not necessarily as strong of thought, you can't bridge that gap. So you can't bridge that gap, that volatility gap, to ultimate success. You might have a great stock idea, but you don't benefit from it because you're bounced out. So you end up capitulating. The market tells you to sell, and then you sell. Maybe they never really knew, as we said. So of course mistakes do happen, but we need to try and differentiate what is the difference between an expected batting average, success rate, from what is really a fundamental flaw in that manager's temperament or approach. And that's what we've really illustrated here. So we're looking for these traits at Stamford to try and identify great managers who have a chance of outperforming.
That drawdown point is a really interesting one, just on a personal level. My personal investment advisor, and maybe this is also a behavioral bias thing, but often they will put a sell order on something if it has one bad month, so one bad drawdown. And obviously, you don't need to be a great investor to know that buy high, sell low is not a great investment strategy.
And often it's baked into the price already, so you're reacting to lagged information. So it's quite dangerous. Yeah.
Exactly. So when you look at this, you talk about the batting average and the win-loss. How do these play into each other, and how does that impact expected success of a manager?
So I think it's important to realize that every manager will have a success rate. Even the best managers will have a success rate. They're trying to form a considered judgment, and they're trying to do that with incomplete information. Now, some will be more talented than others. So, we have 2 stats here. They're called the batting average and the win-loss, and they're an indication of a manager's style, and it's an output rather than an input. So what they're doing is it's telling me the results. What we're mainly concerned about is the decisions that led to them. But this can start as a starting point for investigation. So the chart here is on the right axis, it's showing batting average, and on the left, it's showing a win-loss. And the batting average is essentially the number of winning investments relative to the number of losing investments. The win-loss is the size of your winning investments relative to the size of your losing investments. So you might think about contribution in that regard. So if you're getting half right and half wrong, that's a batting average of 50%. And if they're the same size as winner as they are as loser, then that's a win-loss of 1. And if you've done that, you're in the middle of this chart here, 50% and 1 times. You might have done a huge amount of work, but unfortunately you've just done the index, and you've probably charged your client for it. The line here between green and red, that's showing equivalent ways of achieving that index-like return. So perhaps at one end, it's interesting to point out that you could win 80% of the times. That could be a fantastic batting average as a manager. But if your winners are small compared to your losers, say over here on the far right of the chart, we have 80% of the batting average. If your winners are small, at 25% of your losers, you're still going to deliver the index. That's no added value. So that can happen. And it can happen if a few large positions go badly wrong. And clearly, we need to understand what happened there and whether it has forward-looking relevance if that does happen. So anywhere in that green space on this chart means outperformance, and anywhere in the red space means underperformance. And all managers will fit on this sort of chart somewhere as a fingerprint, and they may not be necessarily aware of it. So for example, just to give you a sense, I mean, it's always dangerous to generalize, but you might think about a good growth manager A great growth manager might be thought of as adding value by running winners and trimming losers. They tend to deliver their outperformance, if they're good, through a fantastic win-loss. So a great win-loss, they're buying businesses that are scaling economics over time, many hundreds of fold sometimes. So that win-loss really drives out performance. But in contrast, their batting average might be pretty mediocre. It could be 50-50. Great value managers, however, they mainly tend to do it possibly through their batting average. So they might be at the far right of this chart, maybe above that one line with the win-loss. So win-loss good, but really they make their money, their alpha, by getting most of their investments right, arbitraging that value difference, and then perhaps moving on. So that's sort of two senses of where managers may fit. The ones we try and look out for are the ones that perhaps might give you an indication of riskier ways to deliver outperformance. So you might have a manager who at a top headline level has delivered fantastic outperformance, but if you look within the holdings, they may have done it through an epic win-loss, fantastically large win-loss on that scale at the top of the chart, but a really abysmal batting average. So just a very few holdings knocked it out of the park. And that would clearly raise questions of repeatability. So the top left of that chart, that's probably where we'll be talking about here. And that will be a very different prospect to one that was based on a broader achievement of success. And we'd need to understand that quite deeply. So how do we use this chart? We'd look at the success rate on regular basis. We try and understand what drove the returns of those positions and what the manager did. We do a huge body of work to try and understand what topics and issues we want to raise with that manager, and then we meet the manager and probe the quality of their decision making. And they're really important, these meetings, because they're pivotal to our conviction. They're not just meetings, they will dictate the course of our conviction. And that's really how we try and add value for our clients, really digging into stock level holdings and seeing whether the quality of that thinking exists as claimed at an underlying level.
It's interesting, this interplay between batting average and win-loss. When you were talking it through, it occurred to me that sort of venture capital would be at one very extreme end of this, where maybe they would have, one or two companies that are 1,000% return, but it's only a very small percentage of those companies that actually succeed.
Yeah, so that's true, and that's one way to generate returns. But it's probably not okay if that's not how the strategy is being sold or marketed, because it goes to the risks that you're engaging in order to generate the return. So having an understanding of what drove those returns and the decisions that resulted in them, it's got to be the center of trying to understand whether it has forward-looking relevance. So all of these are backward-looking stats, remember. I'm trying to understand, what do they tell me about this investor, and what can it tell me about the potential future expectation from this manager?
Excellent. I just have one more question, and then we'll pass it over to the audience. I've seen that have had some questions come in. I think given where we are currently globally, would be remiss not to talk about the current pandemic and the volatility that we've seen in the market. What are some particular behavioral anomalies that you've noticed during this time, or that you particularly look out for during times of volatility?
Yeah, I mean, it's very timely. So clearly we're in turbulent times, and most of the managers we're interested in are differentiated, and to be differentiated means sticking your head above the parapet, and it means you're exposed. So this means in times of turbulence, it can be extremely stressful. So we're looking to see how they react emotionally, how they react cognitively, and that can be diagnostically very useful. So are managers clear-headed? Are they courageous? Do they let their negative traits overwhelm their positive traits? Because we don't think biases are necessarily always negative. They can be a heuristic, a shortcut to avoid danger, but biases can become negative. So we would look out for behavioral traits through a list of 14 categories. That would include emotional regulation, comfort with uncertainty, adaptability, and that would be what our behavioral team would use. We're also looking for specific behaviors. So Are managers truncating time horizons? Are they chasing returns by entering cycles of greater and greater risk? Are they rabbit in the headlights? And all of this is within the context of a dynamic internal decision-making environment. People are working from home for the first time. Maybe their sources and routes of communication have been disrupted significantly. Maybe the companies they're invested in, similarly so. So it adds a huge amount of complexity. And managers might not necessarily be forward about telling you about negative development. So you need to keep a skeptical and open-minded hat on when you're engaging here. So we've really been engaging at a granular level. We've been trying to understand what are their decisions they're making now, because I think that will really make a difference between them adding value or not. And that's really what we've been looking at. What we haven't been doing is necessarily overly interpreting near-term, short-term returns. So what's critical is really to differentiate the difference between what might be a negative return due to a permanent impairment of capital. Well, that story is over. That investment campaign is done. Or negative returns that might be driven by mark-to-market losses. So mark-to-market losses, that story is not over, and that value may return, but the manager will need to explain how they've re-underwritten their investment case, whether it still remains valid. So the only way to do that is to engage. So certainly in this current environment, growth is exceeding value significantly. It doesn't mean all growth managers are great, and it doesn't mean value managers are good. They both can be great, but it does mean we need to do our digging. We need to be able to see that they're sticking to their knitting and their edge. And we need to be able to prove that to our clients. And that's really what our focus has been on in the near term.
That's great. We do actually have a question from the audience that's come through on value and growth. But firstly, just because it ties into what you've just been talking about, we have a question from Xavier Verdeyen, and apologies if I've completely got your last name wrong. He said, great point that past performance is not persistent and it shouldn't be a driver of investment decision. However, I very often see it as a source screening of the manager universe. So how do you define your initial screening, if not performance-based?
Yeah. How we screen, we wouldn't adopt a screen that's based on returns at all. Our initial screen would be about a network of contacts and protagonists, and like-minded investors who are aware of excellent stock selectors in the market. And the reason why we don't look at short-term returns, and even short-term returns can bleed into long-term returns, because a negative year one can pollute a 3-year record, is because it may have no relevant indication as to talent or otherwise. So for us, understanding who are good managers comes down to understanding who is applying a thoughtful and diligent process to understanding the value of what they're investing in, and that applies to growth as well as value managers. And that really comes from having your ear to the ground and creating a network, and really trying to understand where those managers are in their life cycle, because every manager will have a life cycle that one needs to be on top of, but definitely we don't filter through the lens of poor returns on the short-term basis. Clearly, if you have a 10-year record for a growth manager in a growth environment, that might cause you some pause for concern. But if you do see a great manager claiming to have some bottom-up stock-specific skills, the onus is on us to go in and test whether they are doing what they say they're doing. And if there are negative returns, to try and understand whether there's any feature of that return, any driving feature of that return that might not necessarily have any indication on a forward-looking basis. So it can be okay to invest in a manager with negative returns. It can be okay if that negative return has no relevance to that manager's edge on a longer term horizon. So I think that's probably a broad description, if that's okay.
No, that's great. And Xavier, do let us know if you don't feel that question was thoroughly answered. And we have a question from Amir Toma as well, which relates to the value growth discussion points. He said, given your approach, do you have a company bias towards value or growth managers?
Yeah, so I think the context here is we favor fundamental investors, that because we think managers optimize their chances of outperforming by having a sense of the value of what they're investing in, an understanding of the fundamentals. And I think the context here is, various stats abound, but the vast majority of trading, or at least volume activity on indices, is not possibly with any regard to the value of the fundamentals that are underlying. So some stats say 70% is high frequency trading. Add to that the rise of passive momentum strategies looking at share price movement. So a view to the value of what you are investing in from a bottom-up basis is important to us on a long-term view, and we think that could possibly add value if done well. So when we talk about, do we have a preference for value or growth, we have a preference for people who understand the value and nature and characteristic of what they're getting into. That can equally apply for a growth manager. So for a growth manager, one form of valuation discipline might be an expected return over a 5-year period. If that drops between below 10%, that's the same as a valuation intrinsic value control. Another form of valuation awareness for a growth manager is trying their level best to understand that business will get bigger, understanding its competitive edge, its dynamics, its ability to grow. So de-risking that valuation by just trying their level best to understand that growth will come through. So we don't have a preference for value versus growth managers, but we do have a preference for managers having knowledge of what they're investing in. So that's probably how I'd describe that from our perspective.
And so given, and thank you very much for your question, Amir, as well. Rustin Smith from the Tesco Pension Fund has sent through a few questions, which I will get to shortly, but there's another one from Anonymous which follows on from this discussion. So I'll go to that first. Given value's massive underperformance to growth, are you noticing a change in the behavior of value managers and potentially signs of capitulation?
Yeah, it's a really relevant question. So yeah, many value managers are struggling on a relative basis. So are we noticing any loss of conviction? So I think it can be the kiss of death for a manager to deviate from style, philosophy, and approach. So for a value manager, that typically means that they have to normally retain conviction in what they have invested in, but only to the extent that those investment cases remain valid. So what we see is certainly with some of our value managers, we do see conviction and confidence. We see managers backing their ideas because their investment cases were built through a longer term lens, which they rationalize remains valid. And it's our job to go in and test the strength and depth of that rationale. At the margins, this is a huge exogenous shock, which has impacted certain sector fundamentals quite materially. So, whether you can, whether your buy case now on Carnival, for instance, remains as valid, it's a meaningful question. So managers aren't employed to just hold their nerve and conviction without reference to new news. When the facts change, we expect them to incorporate that into their upside and downside. So it then goes into a discussion about the extent of this behavior and whether rotation out of particular investments, which might represent a capital impairment, represents the right thing for investors. And it really comes down to consistency with that manager's style, the extent and scope and scale of that activity. But it has to be sensible for people to reappraise the fundamentals of those investments, and our job is to try and demonstrate that, really.
That Carnival example was a very topical one, because I actually see we have someone from PIF attending today's call, and they obviously took a very large position in that earlier this year. One of the questions from Rustin, which I would like to address: what's your discipline around removing managers, which is one of the challenges that we all face?
So discipline removing managers. So at inception, our aim when recommending a manager is to identify the edge. What is the edge? And then seek evidence that supports that edge. To the extent we recommend a manager and it gets appointed, our job is to keep an eye on all of those key elements that underpin the edge. So does the evidence remain that we can prove this edge exists? And if we can't prove the edge exists, then it's extremely challenging to continue to maintain a buy case. Essentially, we're just recommending a manager who we don't know whether can add value or not. So in terms of sell discipline, it's about gathering evidence, observational evidence. So we need evidence in order to recommend a manager. So that means transparency, inspecting their footprints, testing whether they're actually doing the work they say they're doing. So not just writing down the work they describe to us. And when we shift to monitoring, and I would say monitoring is actually more described as ongoing research. Our job is to make sure that that research is sort of extant. So if the evidence shifts in a negative behavior, perhaps holdings start to tilt upwards, perhaps capacity is exceeded, perhaps turnover starts ramping, and impairments of capital start increasing. The first job is to try and understand the source of that activity, what drove that decision-making activity, because only that has forward-looking relevance. So we'd dig into it and we'd understand it, and we would try and layer our knowledge over time. We wouldn't typically have a single meeting and try and draw conclusions on a single high-level meeting. It would be about doing the analysis, digging into it, and forming our own risk-reward perspective in terms of how we recommend next steps to the client.
It seems like a lot of things that you've been talking about do focus, I guess, on, governance and transparency, which links to another question that we've had in from the audience. Well, one facet of this anyway, which is, how does ESG feature in the investment process, and how does it also add value in your view?
Yeah, it's becoming increasingly relevant. So we consider ESG factors as part of our appraisal, and we certainly think an appraisal of ESG factors can help active managers mitigate fundamental risks. And I don't think that's necessarily a surprising statement. I think that's pretty commonly understood. And if it's incorporated well, it can reduce the probability of permanent capital impairment. And for us, if you reduce the number of capital impairments you improve the probability, the prospect of positive long-term returns. So in one sense, ESG is about another input to valuation. So those engaging in unsustainable practices, they may well see their cost of capital go up, and therefore valuations may go down. So the managers we're focusing on, they tend to care about their investments in great deal. They're trying to understand them. They're long-term holders. They're not speculators, and that tends to go hand in hand with the concept of being a responsible owner, an active owner, if not necessarily an activist owner. Ultimately, they need to demonstrate to us that they're satisfying their duty of understanding the true characteristics of what they're investing in. So potential threats and valuation issues might lie beyond the traditional P&L or the traditional balance sheet. There are lots of potential places to look, but clearly human labor, environmental impact. We get a lot of managers saying that ESG has always been baked into our process. It seems to be a more common refrain, and maybe it has, but we do need to evidence those claims, and we do that at the investment level, the stock or credit level. So if we find a lack of substance, then that's going to ring alarm bells for us. So for one recent research engagement, we evidenced that 70% of internal notes actually did include any comment on ESG, and that starts a conversation. We engaged in 9 investment case studies, specifically probing how ESG fed into that manager's conviction or otherwise on that particular investment. I think for our role, we're trying to evidence their ESG approach. We're not trying to necessarily dictate what the right approach should be, because we think a one-size-fits-all approach may not work. But we do need to see and evidence managers' claims in this regard, because it's in the same way as investigating managed investment approach. We would evidence all claims as part of making a recommendation.
Well, I guess you've got a bigger issue if they say they have something and it's blatantly obvious that they don't. I guess that's a bigger issue you have to deal with.
That's true, but sometimes it might be more nuanced than that. So, for instance, they'll say we have ESG as part of our process, and they do, but it's performed by 2 people in a far distant team who do a sort of checklist approach. It's provided to the manager, but there's no tangible evidence that suggests it forms part of the decision making actually on that stock, and we know that because we engage on that stock in detail as part of a case study. So there are a nuance, and clearly everyone's moving in a direction to incorporate more and more of this, and we need to recognize that we're all on a pathway in a direction. But the key is we need to know the facts. We don't want to be sold a story to. As long as we're all aware of what really is going on, then we can form an informed judgment.
Excellent. We've actually I know we said that we would be 40 minutes, but we do have 2 more questions that have come in from the audience. We have one from Ben Cornforth, which is, hi Mike, just a quick follow-up on ESG. Which ESG providers do you incorporate in your process at the moment?
Yeah, so I think just following on my last chat about this. So for us, I think ESG is about application in practice at a stock level. So you know, there are certainly ESG providers in terms of rankings and ratings, and I think you know, it's certainly worth noting at present those rankings and ratings don't necessarily show a lot of consistency in terms of their the grades and rankings they award. They award certain individual stocks. So, you know, correlations could be, you know, 0.4 to 0.6 per recent studies. And that compares to correlations between, you know, the rating systems on credit quality metrics of, you know, 0.99. So at the moment, we're in this creative period where perhaps we haven't fully settled on what should be good as an ESG framework and how necessary to rank it. So in terms of ESG providers, yeah, we think it's an important and developing area, but we don't necessarily prioritize simple scores of portfolios. It's more about how a manager appraises the risks to an individual position. So if a manager holds a stock that has pronounced ESG issues and has a negative ESG rating or a particularly poor one, it's about understanding why the manager is prepared to invest in that particular company. What engagement have they done on those issues? Are the issues still extant or are they historic? So they need to be able to justify that in great detail. So what we don't do is necessarily run a rule through a portfolio, get a number at the top and say this is a good or a bad number. So yeah, that's just about where our focus is rather than necessarily anything else.
No, that's great. I think that's a really thorough response. And and Ben says thanks, so I guess he does too. We'll take one more question from the audience, which is, how is pricing, i.e. the fees, changing and how do you assess value when considering this proposition? And I guess the net risk adjusted returns as a outcome of this.
Yeah, I mean, I think it's the critical issue. How do you assess value? As I mentioned at the beginning, I mean, value has to be about an ability to add value. One of the most easily visible aspects of that is over long enough horizons, an ability to add alpha. You know, there are other ways to potentially think about value, and maybe that needs to evolve in the context of sustainable investment. But if we are recommending a manager with a certain edge, we need to be confident that edge is sufficient to exceed the fees that they are charging. Certainly, the direction of fees in the industry, you know, I think it's probably fair to say, and everyone will be aware of this, is directionally down, and that's great. But a low fee won't make a great manager good, so it won't make a bad manager good. So you'll just be charged less for a bad product. So fees need to be contextualized relative to the ability to add alpha. And as I say, the discussion for us is forward-looking rather than necessarily backward-looking. It's not just they added X alpha over the last 3 years, and these were the fees. Therefore, the alpha to fee ratio is X. It's about that the appraisal of the talent and whether we think over truly long horizons going forward, it's likely to come through, and that's much more of a not necessarily a statistical exercise, but it's a you know, a more to do with a more rounded appraisal.
Even though there are so many, you know, it is very much a quant and data-driven business, it really is fundamentally a human business at the end of the day. We have run over time, so we're almost at 45 minutes. So I just wanted to thank our audience and our participants. There are a lot of great questions, so thank you very much for your engagement. And also thank you so much, Mike, for sharing your insights today. I hope that we answered everyone's questions thoroughly, but if you do have any more questions for Mike or the team at Stamford, I guess, Mike, are you happy for them to reach out to you directly?
Please, yeah, please do.
Okay, great. I will just bring up, I believe we have Mike's contact details. So yes, please do reach out to Mike, or you can reach out to myself or Kate, who you probably received the original webinar invitation from. But thank you all so much for your time today, and stay safe and healthy. Thanks, everyone.
Thank you. Bye.